you'll soon be able to buy shares in Facebook. It's one of the most eagerly awaited IPOs, well, for an awful long time. With me to talk about it is Mezian Lasfer, Professor of Finance here at Cass Business School. Professor Lasfer, why is Facebook coming to the market?
Well, this is an important question in the sense that we understand that companies come to the market for various reasons. The first one that is very, very important is the funding. So when you need some money, when you are private, you are kind of tied up to the banks, and then banks may charge you very high interest. So therefore, in order to diversify your financing possibilities, you will probably come to the market whereby you raise some funding to invest in your growth. So
Facebook doesn't need to do that, does it?
That is really the question that we have in us. That is really the puzzle, in the sense that Facebook has got about $3.7 billion of revenue, out of which it is generating about $1 billion of earnings. That is really a profit margin, which is very high, about 28%. So therefore, we don't see that really Facebook is coming to the market to raise funding. It doesn't need funding. And that probably explains why they are going to issue only 5%, I think, of the company, or something like that, which is very, very small amount. So it's probably driven by other things. Those other things could be, now it's general for all IPOs, but to a lesser extent valued, is that probably they come for diversification. So they want, the owner wants to sell some shares in order to diversify somewhere else, so to realize those capital gains. They could also raise some money for the image, but the image, Facebook doesn't need it because everyone knows Facebook, so they are not going to spread the word that they exist. But they could also raise some funding for to value Facebook, because valuation of Facebook is really very, very critical, very kind of puzzling.
I'll come to that in a moment, yes, if I can. But just on the Facebook coming to market, it's one of those IPOs which everyone is talking about.
That's it.
Why is everyone so excited?
Well, it's because it's a company that has got currently about 800 million users. So it will soon, by March, when really the shares are going to be quoted, they are likely to reach 1 billion users. So it's a huge amount of users, and all those people, they become attached to the company that they are using. So that's really what the excitement is generated. It's much more from users rather than from the market.
Almost 1/7 of the world's population.
That's true. Yes. So, which is incredible. I mean, it's very, very large, and and therefore those people, we are very, very likely to see many of those people applying for shares rather than the institutional investors coming to invest in this IPO. That's really my guess. But I would think that institutional investors may be reluctant to invest in Facebook.
Now, you mentioned the valuation earlier, earnings of about $1 billion.
Yes.
But the valuation, people are talking 75 to 100 billion. Now that seems way out of step.
That's true. I mean, we have different ways of valuing a company. Well, the two important ones are really what we call the relative valuation, and the other one is the cash flow value, discounted cash flow valuation. Let's focus on the first one. When a relative valuation is to say, really, how much are you going to pay for those earnings that Facebook is generating now? So if it is generating $1 billion, and you are paying for it $100 billion, it means that the PE ratio is 100, and that's really
which is incredibly
huge.
High.
I mean, if you look at
5 times a high PE ratio.
That's true. I mean, if you look at the normal, even probably more, because if you look at the normal companies, even if you just look at the FTSE 100, which are really very large companies, lower risk, etc., you have about PE ratio of something like 12 to 15. That's really the market equilibrium. And so in other words, having a PE ratio of 100 is just incredible. In other words, it's too high valuation for what the company is generating.
So a last cheeky question, would you buy shares?
Well, not me, because I see more risks than benefits from this by investing in this company. As I mentioned earlier, the valuation is too high. I mean, too excessive. Even if we use any method of valuing the company, it's too high. But I want also to focus on the risk, the additional risk that the company has, and this is related to the research that we have done here. Is in terms of this holding by Mark, the founder of the company. So you have he holds about 28% of the shares, and we find that when the managers own this large amount of shares, they are very likely to disregard other investors. So they are likely to manage that company as it belongs to themselves.
The criticism of News Corp.
Yes, that's true. I mean, wherever you have a high managerial ownership, it doesn't create value. So that is again another risk that we could have for this company.
Professor Lasfer, thank you very much.
Thank you very much. Thank you.